Entering and exiting pairs trades. This is a big one for me. We have done a ton of work recently to build interest in pairs trading because we've seen in times of uninterest in the stock market at large, when volatility drops down, stuff is just moving sideways, pairs trades become extremely viable and fun strategies to look at, just comparing two things against each other. But I want to give a little bit more context for entering and exiting these pairs trades, because we've seen some stuff get really out of whack recently. Stock sectors battling each other, different metals battling each other, agriculture markets like corn and soybeans going against each other. And so I want to give a little context into how we look to enter and exit a pairs trade relative to an outright trade. And with that, I want to start by looking at the outright trades that we are comparing. What's been a real fun ride over the last couple of months, specifically the last couple of weeks here, has been the small technology futures relative to the small stocks. And this is where it all begins. It's just I pit two markets against each other. These things trade similarly, but not exactly the same. And so I can look at buying one, selling the other, and then I create with that strategy a spread. So pairs trading, spread trading, same thing. We're looking at the small stock spread here, and this has been a great one until a real break here in the last couple of weeks as technology has gotten beaten up by energies and industrials and the rest of the stock market. We've fallen outside of this range in technology relative to that rest of the stock market. And I just want to bounce back and forth real quick just to show you what you're looking at here. This is STIX minus SM75, and this is STIX and SM75 on the same axis, same time frame there. And you can see what has caused that big dip lower in the spread is this huge divergence. Like they're, for most of this chart, trading on top of each other. When you see a dip in STIX, you see a dip in SM75. When you see a rally in one, you see a rally in the other. The last couple of weeks, technology has just gotten its butt kicked as the rest of the stock market has actually moved a little bit higher. Now, today, we're seeing a big reversion in some of these pairs trades and just stocks on the whole moving lower. But that's what's caused this big move lower in the spread. So hopefully in your mind, you're starting to see this. It's the same with, soybeans minus corn. If I buy one, sell the other, now I'm trading the difference. And you can see it here on the y-axis, the 5-0, and now we're in negative territory. That is simply the difference between these two prices. On the left axis here, we have a STIX market that right now is about $62. On this right y-axis here, we've got an SM75 market that is close to $80. So you subtract the $62 or what have you in STIX from about $80, and you get this negative 18, or right now sitting around negative 15, because I was rounding there. That's exactly what you're looking at. And you've seen in the last year of trading, small technology futures trading on top of SM75 in positive territory. Now they've broken down a little bit as the tech stocks have the pandemic coming to a close, tech stocks losing some of their luster relative to those industrials and energies that get profits and revenues from people moving around and doing more stuff. Pandemic closing, that outperformance in those sectors starting to kick in, and you're seeing this spread move. And so now you're trading and not the stock market at large. You're not just saying, oh, I'm a bull or a bear in stocks. I've got a spread going on that I don't care if stocks move higher or lower. I'm trading this relationship. Now, this is a very different looking opportunity relative to the outrights. And this is why we can, whether stocks are slow or they're volatile, you always can look to these pairs for a diversified play within the same asset class. That's hard to find. When you look for diversification or unique opportunities, you usually have to jump from stocks to crude oil, to metals, to interest rates for that diversification. You can actually find it in the same spot here. Like you can be long technology stocks and long the technology to SM75 spread. And those things, of course, they've got some correlation to each other, but they will move in different directions. Like today, that STIX market moving lower, but the spread is pretty much around unchanged. It's been bouncing back and forth between positive and negative all day. It's a nice diversified play, a unique opportunity. And it does mitigate some risk. Like you look at this y-axis again, the range is -15 to +5. That's $20 worth of range. Looking at the outright in the same time frame, it's $40 at the low, 70 at the high. That's $30 in range. So you did mitigate some of the risk with this pairs trade. Most pairs trades do mitigate some risk, but you still have to have your outs because what's funny, and this happens from time to time, the last couple of weeks here, we've seen a bigger move in this Sticks SM75 spread than the outright itself. We've seen Sticks futures fall like $3 or $4, but the spread trade here has fallen like $7. And so while risk is mitigated in the long term on most pairs trades, you still have to have those outs and you have to have your mechanics. And this is where I want to finish. Entering and exiting pairs trades just comes down to, what are you comfortable with in the outrights themselves? A lot of people ask this question, okay, if I'm long Sticks and I'm looking to make or lose $100, what should I be looking for in the Sticks to SM75 trade? And they think everything is kind of changed now that I'm on pairs trade as opposed to the outright. But it's really the same thing to me. If you're looking for, $300 in your Sticks outright trades or your SM75 outright trades, when I put them together into a small sandwich spread here, I can look for the same kind of thing. But you have to have those same mechanics. And I know, we personally were looking at this spread when it was up here at -10, and then it moved lower. And we said, we would be out of this trade at -12 or -13 because it went through us for those couple of $100. It's the same as trading the outright. So, looking for, and on entering, I'm looking for the same thing. You have an idea like, oh, I want to sell stocks because they're high, or, I want to buy stocks because they're low. Same thing with the spread, just looking for price extremes between these two markets. It's very similar to trading the outright. So entering and exiting pairs trade, going to be a lot similar to your mechanics in scalping just futures in general, outright markets.